What's up, y'all? Welcome to Political Fight Club. I'm Robert Durden, and this episode is Chapter 8 of Matt Taibbi's The Divide. I'm reading it right here. It's wonderful so far. Second to last chapter. It's called Big Frauds. So we'll be talking about J.P. Morgan Chase and some other banks and some of the fraud they were committing during the '08 crisis. And then, by popular demand, the book that we will be reading afterwards during the book club is going to be Viktor Frankl's Man's Search for Meaning, which I've already read before, but I'll read it out loud to you guys in about 4 or 5 episodes. It changed my life. It's a wonderful book, and you guys decided that that was what we should read next, so that's what we're going to read next. I'll also get an episode to you of Ian going over the second half of Donald Trump Jr.'s Triggered either later today or tomorrow. He still is having a little bit of car trouble, so I need to get him over here. I thought it was going to be yesterday, and yesterday I thought it was going to be the day before, so it's just been a couple of things have come up. We'll get it to you. So let's talk about what this chapter was about. It's in a couple of sections. It's about a bank called Washington Mutual, which was bought out by J.P. Morgan during the '08 crisis, and what they were doing to contribute and what Chase was doing when they were actually buying up some of these smaller banks. They also bought up and absorbed Bear Stearns during the '08 crisis. And the official narrative during the crisis, when some of these larger banks were buying up some of the smaller banks, was that they were saving them and stabilizing the markets because these were inherently unstable banks, and it was these big, mainstays in the market that were buying them up so that they could restabilize the market. That's all bogus. The truth is that J.P. Morgan Chase bought out a lot of these banks for extremely cheap, and the reason they got such a cheap price on banks like Washington Mutual and Bear Stearns was that they were a cleanup crew, and JP Morgan's very good at covering up fraud, so they figured they could save a lot of money buying up all of these banks as long as they could undertake cleaning up after all the shenanigans that these smaller banks were doing, and they were very good at it, so that's why they did it. It saved them tons of money. They absorbed a bunch of banks, became enormously, a lot bigger than they were even before the crisis, but it had nothing to do with them stabilizing the markets. It had everything to do with them buying out banks that were already going to go under and just fixing the paperwork and cleaning up after what they did. But it had nothing to do with really cleaning it up. It's just they were really good at covering it up further. So that's what they were doing. I'm going to read to you about that. I'm going to read to you about credit card fraud and how Chase will pay debt collectors to come after people that don't pay their credit card fees. And this system is rigged like crazy against the consumer and the people that take out these credit cards, and rigged hugely in favor of the banks issuing the credit cards. Now this goes from everywhere from the people that they will hire at the debt collection agency to issue summons to people to show up in court. They're just servers, process servers, but a lot of times what they do is called gutter summons, which is they just pay random people who will say that they're going to go out and issue subpoenas or summons to court, and they don't do it. They just shred it, and then it's officially the debt collection agency can say, oh, we handed it to our person handing out the subpoenas, so now it's that person's word versus your word on whether or not you actually got the summons, and rigging it again against you. They don't even actually have to issue a subpoena to you or a summons directly to you, make sure that you actually get it anymore. They just rig it so that it's your word against the people that are supposed to be processing you, and it makes it very, very difficult to prove that you weren't served. Another way that they do it, the actual bank, before they actually send some of these files over to a debt collection agency, is that you need an affidavit signed by somebody who's a higher up at the bank who's gone over your file in depth before you can issue a summons. That affidavit is supposed to be signed by someone with credentials, but what a lot of these big banks do is they just give random people or people that are very, very low in the hierarchy who are not capable of going through these files in depth to see if they're actually accurate and to see if you actually owe the bank money. And they'll just give them an unofficial title that sounds very official and have them robo-sign hundreds of these files in a room without even reading them. And who's to say these people, some of them don't even work for Chase. So it's ridiculous the level to which they're willing to go to screw you. And I'm going to read to you in 3 or 4 different sections about how that goes. We'll start off with Linda Almonte, who is she was a fixer for JP Morgan, who would go to a lot of these banks that JP Morgan was planning on buying out, seeing how bad it was, but also she did internal audits mostly after the fact, like after things were bought out, and then she would go see how bad the things that Chase now owns are, and all the she also saw the writing on the wall with all the fraud that was going on at Chase. So I'm going to break that down for you in this first section. It's going to be a little bit long. The second two sections will be shorter, okay? So let's read to you about Washington Mutual and Linda Almonte. Once the sixth biggest bank in America, Washington Mutual in September '08 collapsed in what was at the time the largest bank failure in our nation's history. The bank had gone out of business thanks in large part to its mania for trading in fraudulent, designed-to-fail subprime mortgages. In fact, in '03, in one of the most unintentionally prophetic statements in the recent history of high finance, then CEO of WAMU, Kerry Killinger, had announced an audacious plan to turn his bank into a kind of Walmart of debt. Quote, "We hope to do to this industry what Walmart did to theirs, Starbucks did to theirs, Costco did to theirs, and Lowe's Home Depot did to their industry. And I think if we've done our job 5 years from now, you won't even be able to call us a bank." End quote. Killinger was exactly right. In exactly 5 years, people stopped calling Washington Mutual a bank. But it wasn't because it revolutionized the industry, it was because it so completely gorged itself on phony loans that it went out of business. In his craven desperation to become the country's great volume distributor of debt, Killinger, among other things, acquired one of the most corrupt companies on earth, a California-based subprime mortgage lender called Long Beach. In an era where companies like Countrywide and New Century set new standards for underwriting negligence, Long Beach was the worst of the bunch. It was completely indiscriminate, lending to anything that moved, falsifying income statements, faking credit scores, doing anything to get people approved. Over a 4-year period, WAMU and Long Beach teamed up to become a veritable factory of subprime mortgages, going from spending $4.5 billion of subprime securitizations in '03 to $29 billion in '06. They would ultimately securitize more than $77 billion in subprime mortgage loans. WAMU knew that the loans it was getting from Long Beach were fraudulent. A Senate investigation later revealed that the bank had, among other things, done internal audits of two of Long Beach's most productive loan officers. They found fraud in 58% of the loans coming from one of those officers' operations and in 83% of the others. Instead of firing these two men, they were given prizes for loan production. Another internal bank review in '08 found that loan officers were literally manufacturing information for loan applications in order to speed things up, yet they weren't fired. Why? Because they were doing their jobs. They weren't in the business of making good loans, they were in the business of creating assets, and almost nobody created more assets than WAMU. The two problem officers were like toy factories that were caught using edible lead paint on the products, but also produced lots of toys at low cost. The wrong kind of parent company wouldn't care, and WAMU was the wrong kind of parent company. The Senate report also found that the bank intentionally chose failing loans to sell off and systematically hid negative information from the investors who bought these mortgage-backed securities. From the report, quote, "Documents obtained show Washington Mutual selected loans for its securities because they were likely to default and failed to disclose that fact to their investors. It also included loans that had been identified as containing fraudulent borrower information, again without alerting investors when the fraud was discovered. An internal '08 report found that lax controls had allowed loans that had been identified as fraudulent to be sold to investors," end quote. WAMU's efficiency in creating bad loans was not what killed it. What killed it was its failure to efficiently get rid of its own defective product. The bank was dumb enough to get caught holding or warehousing too much of its own born-to-lose mortgage paper. So in '08, when the home prices declined and home defaults started to pile up, the bank suddenly split open like a ship hitting an iceberg. Seeing this, depositors and investors began to flee. In a 10-day period from September 15th to the 25th, customers pulled $16.7 billion in deposits out of the firm. A classic run on the bank had begun. In order to prevent a catastrophe in which the government and the FDIC would have to compensate thousands of wiped-out customers, the state, in the persons of such luminaries as Hank Paulson and Timothy Geithner, first seized the bank and then hastily arranged for it to become shotgun-wedded to J.P. Morgan Chase in an 11th-hour backroom deal. This is where I was talking about, guys. This is where it gets interesting. In that highly sordid and mostly overlooked chapter in the history of the bailout period, WAMU and its $307 billion in assets were delivered by the state into the hands of Chase and its CEO, Jamie Dimon, for the preposterously low price of $1.9 billion. A bargain deal that was struck just a few weeks before Chase was given $25 billion in cash by the government as part of the TARP bailouts. This was Chase's second sweetheart deal in less than a year. 6 months before, in March of '08, Chase had rescued, quote-unquote, the imploding investment banking giant Bear Stearns, buying the venerable firm with the aid of $29 billion in guarantees extended by the New York branch of the Federal Reserve, whose chairman of the board of directors at the time was, get this, J.P. Morgan Chase CEO Jamie Dimon. That means that 6 months after Jamie Dimon was the lucky recipient of his own Federal Reserve bailout in order to acquire Bear Stearns, his bank was given another $25 billion in cash by the state to go on another shopping spree, cash he used, among other things, to buy WAMU. Why would the state agree to give two of the jewel assets to the commercial banking world to Chase for almost nothing? What service was Chase providing? The official story was that it helped stabilize the markets, but another answer seems to be that Chase was swallowing up a potentially disastrous public scandal at a time when the markets couldn't survive many more of them. Both of these cozy deals for Bear and WAMU allowed the state to conceal massive criminal conspiracies from the public and the markets by burying the toxic, fraudulently generated assets of these corrupt companies in the billowing skirts of a stable, quote-unquote, reputable, too-big-to-fail company. In exchange, all Chase really had to do was cover up the mess by keeping the extent of the fraud and the toxicity under wraps. All of this is important background to Linda Almonte's story, because when Linda discovered that Chase itself was jumping headfirst into the business of knowingly unloading fraudulent assets onto the market, she would run to the government to blow the whistle, as any good citizen would. But Almonte had arrived at Chase in the first place only by means of a government-approved scheme to conceal toxic assets from the public. The company's state-sanctioned job was to hide fraud from the public, so when she found more fraud at Chase, where was she supposed to go? To the same government that used Chase to cover up those two earlier scandals? And let's move ahead real quickly here. Here we go. The easiest way to explain the debt-buying business is to think in mafia terms. If you owe money to a bookie and he gets tired of trying to collect from you, he might sell your debt to some leg-breaking ex-boxer for 25 cents on the dollar. The boxer then shows up at your house and slams your hand in the car door until you pay. Everybody makes out. The bookie gets at least 25% of the money that he thought was lost forever, a sunken cost. The boxer gets a 400% profit on a small investment, a win-win business. It's the same with banking, and in particular credit cards. You might open a credit card account with Chase, but if you go delinquent and Chase can't get you to pay by normal means, it can sell your account for pennies on the dollar to a debt buyer like NCO, which is basically just a giant clearinghouse for lawyers, legal leg breakers, who earn their living filing lawsuits against delinquent borrowers. NCO is one of the biggest lawsuit factories in America, filing thousands of suits a year against delinquent holders of consumer credit accounts. Quote, when you see someone has been sued by a bank, a lot of the time it's actually NCO, says Linda Almonte. She worked for NCO for that 4-month period in '09, helping the company coordinate communications among a vast network of collections lawyers to whom it farmed out its accountants. Quote, I was the liaison between NCO and their attorney network of 154 firms. That experience of working for its major debt-buying subsidiary and liaising with attorneys is part of the reason Chase decided to bring Linda to San Antonio in 2009. Its plan was to put her in Chase's credit card litigation department, a kind of bureaucratic way station for processing the accounts of Chase cardholders who had gone past a certain point of no return. A sprawling consumer operation with millions of customers, Chase maintains a giant centralized database called the System of Record. The System of Record, think of it as a kind of all-knowing HAL from 2001: A Space Odyssey. The bank enters all kinds of account information, everything from the name and address of, say, a credit card holder, to his or her payment history and current balance, the customer's specific spending limit, and so on and so forth. Anytime anyone has contact with a customer, anywhere, the result of that contact gets entered into HAL's memory. However, once Chase decides that a certain credit card customer is too delinquent on his payments and must be sued, Hal turns that person's account over to the credit card litigation department. From that point forward, the department is responsible for maintaining everything to do with that account, from reading correspondence from the cardholder or the cardholder's lawyer, to gathering information from the cardholder's file to help Chase's pitbull lawyers sue the delinquent customer, to checking and rechecking the documents in those files if and when Chase decides it wants to sell the account to a leg-breaking debt buyer like NCO. Linda expected that her job at Chase credit card litigation would be roughly similar to the jobs she's had at WAMU and NCO, liaising among multiple departments, troubleshooting administrative system problems, and in particular, handling communications between Chase executives and company attorneys. But there were many things Linda didn't know about the job she was taking. In the first months, she claimed she witnessed fellow employees shredding correspondence from delinquent credit card holders, a practice she says sent many customers, some of whom may even have been agreeing to settle the offers, straight into litigation. She also claims that some of the shredded documents belong to active duty service members in places like Iraq, who under federal law cannot be sued for, among other things, credit card debt. When a bank like Chase goes into court to sue a credit card holder, it must formally list the facts of the case, who owes what, how long the amount has been owed, when the account was opened, and so on. And this is what I was talking about, guys, is the important part about the affidavits and how they get you. The procedures in every state are different, but at some point in the process, all states require an affidavit from the bank asserting these facts. The same process holds true incidentally for foreclosure filings. The files for all of these court actions, be they credit card default suits or home foreclosures, include affidavits in which an ostensibly authoritative bank executive attests to the facts of the case. At Chase, those authoritative bank executives were low-ranking employees who also doubled as roving auditors of Chase's out-of-house lawyers. In Linda's office, there was a small cubicle island of these employees stationed about 20 feet from her. They were, quote-unquote, late 20-somethings, early 30-somethings workers, and Linda gave me a list of their names. I would eventually see the same names with regularity on random visits to courthouses to look through public records of credit card lawsuits. Linda didn't know much about what these people did for a living initially, but she did take notice of who they were. Despite their exalted titles, they were not high-powered, serious business executives, but rather entry-level employees who until recently had been hourly wage workers. She remembers particularly that one of the robo-signers had a cubicle decorated with pink poofy things and a sign that read, "The Princess is in." These entry-level types would be sent around the country to visit Chase's partner law firms and, quote-unquote, audit their operations. Linda thought that was odd enough, but what really caught her attention was when, in one of her first audit and compliance meetings, one of these employees talked about how much work he got done on the road. Quote, he was like, "It's a 6-hour flight and I signed 2,000 affidavits," Linda said. Soon Linda was walking by the desks of these robo-signers and noticing that on any given day, they would be furiously attaching signatures to monstrous stacks of documents. She eventually learned that the whole system operated like a factory. At the end of the office, a paid-by-the-hour temp worker would generate an affidavit on a computer screen using an automated program that created a legal document and automatically filed in data from the customer account. Once the document was generated, the temp worker would print it out and then stick all the unsigned affidavits in a drawer. The robo-signers would then open that drawer, pick up hundreds of affidavits at a time, head back to their cubicles, and sign their names to them one after the other. Technically speaking, the signatories were supposed to verify the numbers in the affidavits and make sure the balance number was the same in all the various databases in the HAL-like system of record, in the pre-litigation database, and perhaps even in the databases of the law firms doing the suing. But the robo-signers checked none of these figures. They simply signed their names one after the other. Then, once they were finished, they would stick the stacks of documents back in that same drawer where they would be retrieved, maybe that day or maybe a day later, by a notary who would then stamp the affidavits. The notaries, according to Linda, were almost never in the room when the documents were signed. Oh, geez. So that gives you an idea about those robo-signers. And that's what I'm talking about exactly. So here we go. In October 2011, just a few weeks into Occupy Wall Street protests, that fairy tale gained new life. And it's talking about here, let's go back one more paragraph to give you an idea. Here we should digress for a moment to talk about a legend that's been circulating about the financial crisis. A legend our leaders tell over and over. It goes something like this. Yes, bad things happen, but none of these bad things are crimes. Greed isn't illegal. Making too much money isn't illegal. Nothing to see here. Please just move along. In October 2011, just a few weeks into Occupy Wall Street protest, that fairy tale gained new life. It came directly from the top this time. Barack Obama, the great progressive hope, explained in a series of televised interviews why there hadn't been more criminal prosecutions of bankers on his watch. Obama gave a simple explanation, quote, "Banks are in the business of making money, and they find loopholes." So what kind of loophole finding went on in Chase's credit card litigation office? Not only did the bank apparently have full-time employees assigned to the job of committing mass perjury, it even went so far as to rope the entire department into the cause when the normal robo-signing staff couldn't handle the workload. According to another employee in Linda's department who has since left the bank, it was routine for bosses to come trolling through the San Antonio office with stacks of documents and pull people out of their desks for robo-signing duty. Quote, they, the bosses, were going into an empty room and sitting with stacks and stacks at every table in front of them. Everybody that wasn't doing something was then given a stack and told to sign. They were all in one room just signing crap. This employee, who had been with Chase for years, eventually had to resign because, quote, jail is not where I wanted to spend my retirement. So that tells you exactly the idea. So that's what I wanted to go over in terms of how they will create affidavits that are bogus, and that's key, because in the end I want to tell you guys how you can avoid this stuff if it ever happens to you, and Taibbi does a good job of explaining like how you can fight this stuff, because a lot of people do get roped into this fraud and they end up paying money that they don't owe, and a lot of they get a lien put on their shit so that they can have stuff taken by the bank, and you don't want to have that happen, so we're going to talk about how to solve it at the end here. Alright, part 2. To back up for a moment, the most valuable kind of credit card account to any bank or any bank can sell to a debt buyer is called a court judgment. If you have a delinquent account with a bank like Chase but haven't been taken to court yet, well, that's one thing. Maybe the bank made a mistake. Maybe you don't really owe money, or you don't owe as much money as they say. If Chase goes and sells your account to a third party, that third party will have an uphill climb getting its money, especially if you dispute its claims. And that's the key. You have to try to dispute these things. A lot of times it becomes so costly that they just don't bother. If Chase has already taken you to court and a judge has already wrapped his gavel over a judgment against you for $1,000, well, that account is worth a lot more. The legal leg breaker or buyer of that account needs only to find you and take his money by any means necessary. And the means now available to these collectors are extraordinary. And you won't have the right to argue the matter. So whenever a bank like Chase needs to raise quick cash, selling judgments is a quick and dirty way to go. You scrounge your entire client list to see who among your credit card borrowers has already been litigated against. You gather up all those court documents, and then you sell 500 or 1,000 or 2,000 judgments at a time to a third party like NCO. There were more than 23,000 accounts in the proposed sale. Linda had 2 weeks and a full-time staff of 3 to complete a job that would, if done correctly, require thousands of man-hours. She would ultimately get to bring in more staff to help go through all the accounts, but at the time it seemed impossible. Linda went to work to gather the documentation. The sale of the judgment accounts had been brokered by a company called National Loan Exchange, a sort of middleman firm that put together debt buyers and companies like Chase that had judgments to sell. These middleman firms typically have to tell the buyers that they've done due diligence on the sale. So when a big sale like this is brokered, they'll work with a company like Chase to make sure the bank is selling what it claims to be selling, and that's Linda's job. This is what happened here, and NLE employees along with Linda started to go through those 23,000 judgments. They started with California, where a large chunk of the credit card holders who lost these court judgments lived. Linda asked for and began to receive documentation for 11,472 judgment accounts involving borrowers who lived in California. Quote, there were thousands of boxes, she said. There were rooms filled with this stuff. She started going through the accounts. On the very first day of the review, October 10th, she noticed a huge problem. In each of the boxes coming from California, there were about 45 customer files. Quote, on average, about 10 files in each box didn't contain judgments, and there were another 10 that had judgments that weren't signed and stamped. She says, this early review suggested to her that up to 44% of the judgments that Chase planned on selling were not in fact valid. Worried, she conducted a more thorough review. 5 days later, she had the disturbing results, which she emailed to her another helper of her team, Lazenbat, the Chase sales executives, and Chase lead counsel, Gail Siegel. Quote, upon completion of California PAN files, we have 11,472 accounts, including MRAs, with a total balance of $110 million. Between 50 and 60% of the files are missing judgments, or the judgment does not contain a date and a signature. Linda's bosses told her not to worry, that if the judgment wasn't in there, the debt buyers would just have to go get it themselves. Chase, they said, didn't have the resources to scare up all those documents. And she goes on, let's see here. Now, there were many problems with the accounts Linda was seeing flowing from places like Cali and Illinois. Some were not even judgments. In some files, the cardholders were not even delinquent. In others, Chase actually owed the cardholders money. And still more, there were judgments, but the judgments weren't against the borrower. They were against Chase itself. And there was one last category of screw-up. In large numbers of these files, the judgments were not final. Some of them had been rescinded by later court actions, so the files might have two legal notices in them, the original judgment and the later court reversal. When Linda explained this situation, her bosses essentially ignored her and told her to plow ahead with the sale. She was mortified by Chase's seeming indifference to the fact that they were about to sell what seemed to her a huge quantity of defective accounts. And for her, this was the major sobering difference between even a firm like WAMU and Chase. At WAMU, there had been rampant system problems too, but in Linda's experience anyway, the company had tried to fix them. Quote unquote, I thought it was the same at Chase until they were like, just hide it, bury it. Finally, as the date of the sale approached, Linda was sent a kind of query document by NLE. Quote, it had this whole long list of questions that I was supposed to email back saying they were all true. Like, for instance, that the accounts being sold were free of any liens and garnishments and that there's a judgment against each one. Linda was now being asked to put her own signature on a document that said Chase was selling $200 million in valid judgments, when she believed that this wasn't remotely close to being true. Linda was frightened, but at the same time she was also naive enough to think that the moment might be an opportunity for her. As she later explained to her lawyer, she thought that by stopping the sale and preventing this gigantic fraud from going through, she would be noticed upstairs and become a superstar at Chase. She even tried to end run her immediate bosses and stop the sale herself, believing that she was taking dramatic action to save the company from future trouble. Instead, she was fired. Once Linda was out the door, Chase put the sale back on. Errors or no errors, they quickly found a buyer, and 23,000 quote-unquote judgments went out into the world, a teeming school of little mutant fish swimming blindly into courthouses from one coast to the other, each in search of a human being to collect from. So I read that to you because it's too complicated for me to just kind of explain off the cuff, and I wanted you guys to understand exactly what happened. So you get the idea about the robo-buyers now, or the robo-signers, excuse me. These were absolutely fraudulent judgments, and most of them are. And we have this facade, this illusion in this country that like the bankers are very smart people with numbers, and you get like this image in your head of them like crunching numbers into a computer someplace and really trying their best to do what they can for the people that put their money in the bank. No. They're just cheaters across the board, and they're trying everything they can to make money for themselves and their Wall Street buddies, and it's all about exploiting the system. That's what their entire job is. I mean, the tellers that you guys see that are just pawns that dispense the money at the bank, they might not be in on it, but everybody that's higher up at a bank, all they're doing is cheating. That's it, and this explains it in graphic detail. Let's talk about now... I want to talk about the second thing that they will do, or what these debt buyers will do once they've bought these judgments and they have to go out and collect from you, these collection agencies, these leg breakers. They will often pawn off a lot of their judgments or their summonses on people that aren't really like process servers, and they never actually get you a summons because they hope that you won't show up to defend yourself. Or to challenge the judgment, because they know that there's a very good chance that that judgment is light on paperwork, invalid in some way. Okay, let's see here. The only way, okay, well, let's actually go back one bit here, right here. It took an out-of-the-box judge, like Judge Stranier, to take a second look at the 133 assignments from DebtOne, which is the leg breaker who bought a lot of these from J.P. Morgan, that arrived in his courthouse in March 2010. Incredibly, this courthouse in Staten Island was the only one in the entire country that paused before letting DebtOne proceed with the collections of these 23,000 mutant accounts Chase just months before had pushed out into the world. The law is, of course, supposed to be precise in this area, and civil lawsuits are designed to be careful, evidence-based determinations of right and wrong, liability and no liability. But the business of credit card litigation is by its very nature half-assed, brutal, reckless, and stupid. The business model just doesn't work otherwise. The giant consumer credit merchants like Chase, who file lawsuits against cardholders by the tens of thousands, couldn't even begin to make real money, real margins, if they had to do everything like real legal work or meet anything like real evidentiary standard. Why? First of all, because the services of even the worst civil litigator cost hundreds of dollars an hour. If a bank like Chase had to hire a real lawyer to collect on each and every person past due $800 credit card balance, it would almost certainly go into the red long before the complaint was ever written up. In fact, just getting a human being to look at each and every file for more than a few seconds or individually prepare the evidence for every lawsuit would make the cost of litigation prohibitive for these massive companies. Therefore, the only way to make this thing work to scale is to fully automate the entire litigation process. You must reduce the entire business to a series of dumb mechanical maneuvers that ruthlessly eliminate even the mere possibility of subjective judgment. And that's exactly how it is. The system is really a game of mathematical probabilities that the companies have built around the high likelihood of obtaining uncontested legal judgments. And that's the key, uncontested. We'll go on here. This game begins when the bank serves a summons to the cardholder. In this key first step lies a huge share of the industry's dependable profits. In most states, companies have no real obligation to make sure that the cardholder actually sees and understands the summons. Thanks to intense state-by-state lobbying by companies like Chase, it's usually enough to send a notice by mail to an old address, often the original mailing address when the account was opened, which might have been 10 years earlier. In some states, banks and debt buyers can even make use of an automated online system in which a few lines of customer data are entered, perhaps or perhaps not by an actual human being, and, get this, a postcard is then sent in the mail to whatever ancient address the company has on file. Visitors to online high-speed litigation sites like the deliciously named www.turbocourt.com can get a window into the world of up-tempo collections. Its website, complete with cutesy illustrations, promises friction-free collection. Quote, "We'll guide you through a customized interview, prepare the exact documents you need, and help you file and prepare the next steps. It's as easy as that. A do-it-yourself service that's fast and stress-free." Even in those instances where a flesh and blood process server is supposed to be employed, the system is full of cracks, and this is what I was talking about earlier. The command structure here typically goes from the bank, which wants to sue the customer, to the law firm hired by the bank to press the suit, to the process servers hired by the law firm to find and serve the cardholder. On paper, it's a simple and logical system, but here again the question of margin creeps in. Most of these process servers are paid bulk rates by the lawyers and make as little as $4 per customer per service. $4 per customer. How does anyone make money driving 30 or 40 miles to personally deliver a summons to one defendant to make $4? Your local pizza maker has a higher rate of return on delivery, and even he knows that the job stops being economically viable beyond 10 or 15 miles. So what happens? Many process servers and law firms engage in a wink-wink, nudge-nudge business called gutter service or sewer service, in which the law firm hands the list of summonses to a server, and the server simply dumps them in the gutter, hence the name. In return, the process server hands the law firm an affidavit of service, quote-unquote, swearing that he properly served the customer. Process service once required a signature of the defendant to prove proper service. Now all that's needed is the server's own word that he did the job. Around the time that Chase was obtaining judgments against 23,000 account holders, dozens of law firms and process servers in New York State alone were being accused of gutter service practices. William Singler, the head of Long Island firm called American Legal Process, was arrested for gutter service in the spring of 2009. Soon afterwards, lawsuits in other parts of the state asked 36 different law firms, including national firms like Zwicker and Associates, often used by Chase, to disclose how often they used American Legal Process to issue summonses. Later on, several states would sue Chase, based in part upon information given by Linda, and some would mention this practice. A suit filed and signed by then California Attorney General Kamala Harris in the spring of 2013 would make particular note of it. Quote, defendants, through their agents for service of process, falsely state in proofs of service that the customer was personally served, when in fact he or she was not served at all, a practice known as sewer service. Thus, not only may a credit card customer legally be served some ancient address without her knowledge, it's highly possible that the server won't even bother to extend the person that courtesy. This is why, in a huge percentage of credit card cases, the cardholder never even sees the summons and consequently never appears in court to defend themselves. For instance, in the year many of these cases were pursued, in 2009, there were 240,000 filings of credit card suits in New York City alone. In an astonishing 158,000 of those cases, the creditor won a default judgment, which is where you don't show up in court. Once a bank like Chase serves its delinquent customer, there are just three paths on the flowchart of outcomes. They are A, the customer doesn't show up in court and loses by default. B, the customer answers the summons and settles with the bank. And C, the customer answers the summons and contests the case. In these first two cases, and this is the crucial part of this entire scheme, and the key reason that Linda's bosses were so unconcerned about the absence of good paperwork in the debt sale, the collector typically does not come into court with any supporting documentary evidence. Quote, this is Judge Stranier. They almost never have evidence on the first appearance. All the collectors typically have is a complaint and the assertion of an owed balance. But in the vast majority of cases, that's enough. 2/3 of the time, the defendant doesn't show and loses automatically. Others get the summons, assume they really do owe the balance stated, and either agree to pay or settle, never forcing the bank to prove its claims. The third path, however, and this is the solution that Taibbi offers, in the third path, however, when the customer contests the case, the bank is forced to go back and dig up supporting documents. If the entity doing the suing is the actual bank that issued the card, that's less of a problem. Say Chase's credit card litigation department is filing the suit. In that case, all it needs to do is make a few calls to its regional offices to dig up the card balances and other documents. It's a time-consuming process and puts some strain on the bottom line cost-wise, but it is feasible. But if the collector on the account is a debt buyer, like DebtOne, that has bought the account from a bank like Chase, now there's a problem because the big banks often intentionally keep the files they send to DebtOne thin when they sell their credit card accounts. Why? Because very often the contract between a company like Chase and a company like DebtOne specifies that if the buyer needs any additional documents to collect on the debt, he has to come back to Chase and buy them. Quote, each time you need more paperwork to press your case, the bank charges you for more paperwork, explains Judge Stranier. Quote, it's another way for them to make money, explains Linda. For this reason, when credit card holders actually contest the lawsuits filed against them, the plaintiff in the vast majority of cases, particularly if it's a debt buyer, simply drops the case. So, to recap, 2/3 of the defendants who get served with summonses don't show up and they lose. A large portion of remaining cardholders settle or pay voluntarily. In the rare case where the defendant contests, the plaintiff most often simply vanishes and drops the case. In only the rarest of instances does a credit card lawsuit ever stay contested by both sides long enough to actually proceed to trial. Quote, I haven't tried a credit card case since 97 or 98, says Judge Stranier. So I got one more thing to talk to you guys about, but what that covers is how the system is rigged by not only the people who buy this debt from banks, the leg breakers, but it's also rigged by the banks to sell to the debt buyers. And like I said, it's all a grift. All of this is cheating. So we need to stop looking at bankers like they're smart people in the room. No, they're the greediest people in the room. And this book is an eye-opening experience for me in that realm. Last part here, guys, and then we'll finish it up here. I want to talk about what actually came of this the J.P. Morgan Chase and the WAMU case here. Let's see here. So Judge Stranier was given those judgments, and he ended up killing all 133 of them because they were so sloppily done that he was basically just like, no, I can't. That this is all obviously a grift. So I'm going to read to you here. In this case, Judge Stranier's office took one look at DebtOne's assignments and immediately saw a host of problems. For one thing, the assignments were signed not by a lawyer for either Chase or DebtOne, but by Chase robo-signers, like we talked about earlier. Moreover, DebtOne, a Louisiana company, was not registered to do business in the state of New York. Also, Chase never informed any of its customers that their debt had been assigned to a new company, which according to the judge's ruling was a red flag in light of recent experience. Quote, on a regular basis, this court encounters defendants being sued on the same debt by more than one creditor, alleging it is the assignee of the original credit card obligation. Without receiving such notice of the assignment, the debtor seeking to make any application to the court would not have any idea as to which alleged creditor is to be actually served. Judge Stranier in his decision also expressed concern about whether the defendants had been served properly, noting that, quote, the recent experience of the civil court shows large numbers of default judgments being obtained on credit card cases against consumers far in excess of the default rate in regard to all other litigation, end quote. For that and other reasons, Stranier vacated all 133 assignments he was given. His decision had absolutely nothing to do with the abuses Linda Almonte had witnessed. In fact, until I told him, he had never even heard of her and had no idea of the problems that even existed. All Stranier saw was the broad sloppiness and inattention to procedure that attended the entire deal in general. The DebtOne deal was simply a typical transaction in a consumer credit industry that depends on robo-signing, mass fraud, and intentionally thin paperwork as essential elements of its profit model. Stranier didn't nix the DebtOne judgments because he knew, as Almonte knew, that a large percentage of them were rife with errors and might not even have been valid judgments. He did it because the accounts had been so sloppily transferred that it was impossible to tell the difference. Months later, perhaps because of the Stranier decision, which caused judges in other jurisdictions to review their own batches of assignments in this debt sale, Chase issued a series of curious decisions. In June 2011, it announced that it had dropped 1,000 collection suits related to the Almonte allegations. The suits were from 5 of the biggest states in the debt sale: New Jersey, Cali, Florida, New York, and Illinois. In May, the bank had already announced the firing of its lead counsel in 4 of those 5 states, along with the bank's senior counsel overall, Gail Siegel, who was one of the lawyers present in San Antonio on the day Linda was fired. The decision by Chase to give up on collections from 1,000 accounts was hailed by the few reporters who covered it as a big deal. Forbes reporter Stephanie Edelman, who had previously interviewed Linda, called it a quote-unquote whistleblower triumph, while CNN reporter Colin Barr wondered, quote, do we have a credit card robo-signing scandal on our hands? But Barr pointed out that even this embarrassing episode, which apparently resulted in the purge of the bank's top lawyers, was not likely to hurt the company's bottom line much. Quote, assuming the bank has dropped 1,000 cases against debtors with an average balance of, say, $30,000, twice the national average balance, the amount J.P. Morgan is foregoing is to the order of $30 million. That's about 12 hours worth of profits in the first quarter rate. In point of fact, the average balance in the 1,000 cases was about $1,000, meaning that Chase was really only going about $1 million into collections. In other words, Linda Almonte's whistleblowing odyssey, a journey that had cost her her savings, nearly wrecked her marriage, and reduced her kids to dependence on food stamps, had ultimately cost J.P. Morgan just a few minutes in profits. From the bank's point of view, Linda's defectation was very nearly a worst-case scenario, and even in this worst case, it turns out it wasn't all that bad. So that's where I'll leave it. You get the idea, and without pontificating on it too much, I think you understand. This system is rigged. It's rigged from the banks that will do absolutely anything to get you to sign on to these credit cards. They'll give you fraudulent mortgages. It's all a game for them to trick people into giving them money, and they just make off like bandits and help their Wall Street friends. They're all the same people. This is all the same group. But also, these debt buying companies, they, got to make their money as well. That's the leg breakers. And to make their money, they can't actually summons people the way that you're supposed to summons people, give them subpoenas to show up in court. So their profit model or their business model is faking that they actually summoned the people that actually owe this money, and allegedly according to Chase, and they just completely fake it. And then if you don't show up, you get a default judgment and you're in trouble. And the point is that you don't show up. That's why they do it this way, so they can produce default judgments. And then it's your word against the server's word as to whether or not you were actually even alerted that your account was fraudulent or it was delinquent. So it's a rigged game, folks. As George Carlin once said, all of the oligarchs are in a big club, and you ain't in it. And the quicker we realize that, and the quicker we realize that we're being run by crooks, and that the loonies are running the asylum, the better. So I hope that didn't go too far overboard. I know it was kind of a long episode. I wanted to keep it to about 45, 50 minutes. The first episode I did was well over an hour, so take it from me. It was actually a truncated episode in this instance. So hope you enjoyed that. We will do the next chapter sometime next week, and that will finish up Matt Taibbi's The Divide, and then we will start Man's Search for Meaning later. Keep fighting the good fight out there, guys. I'll talk to you later.